Yeah, I think there's a lot of logic for doing short-term deals too, because if you can get somebody to cover the next year or two, you're going to get past a market where there's, high single-digit vacancies, and then your existing product is going to be better positioned than new product, which may be facing higher construction costs and need to achieve higher rents. So I think I really like the idea of doing short-term leases as a bridge to the future.
Yes, no, that all very interesting, and I know we've as an institutional developer, we delivered 4 buildings this past year, and I'm glad to hear that because of rising costs that we might be surprisingly a lower cost provider with a high quality Class A product. So that might be an interesting turn of events right now. But no, I think rising rental rates and potentially that will impact yields because the developer or will have to absorb some of this. And I guess that leads into, new development, how is it financed? How is acquisitions? What is the exit strategy? Obviously for an industrial REIT like EastGroup, we're long-term holders of real estate. So we're, spending a little bit more time and more cautious of long-term holds and making sure the products are designed for something we'd want to hold for, many years into the future. But how is the capital, we're seeing rising construction costs. We've talked about supply, which we think is, we've touched on a little bit. That activity has, at least the panel before us, activity, I think this first quarter will be surprise a number of people outside of Houston. I think the Houstonians realize where we are and how resilient the market is, but I think we'll have some encouraging leasing numbers this first quarter. But where do we see capital flowing into Houston right now? And what type of product are they focused on within the industrial? David, you want to jump in on that?
Sure. Yeah. We're tracking. I think everybody knows mid last year, there was this intense focus from the institutions on industrial because there was a lot of concern about where office and especially retail were headed. So amongst the major commercial food groups, industrial really was the big winner last year, not only from a performance standpoint, but definitely from a capital standpoint. I think that's moderated just a little bit, not a lot. I think industrial demand from a capital standpoint is going to be tremendous this year, but it does seem like it's off a hair, and there's a couple of reasons why. I think the capital is starting to look at the other property types, not so much retail, but perhaps office and some other spaces, and think about not getting too focused in one area in terms of their new allocations. And the other thing is we're seeing less industrial come available for sale than we did kind of at that peak period, late summer, early fall last year, when everybody was trying to play catch up from not only a sale, but a getting the capital out standpoint. So the other driver at this point is institutional capital is tracking, real yields, and those are dramatically rising over the last couple of weeks. So everybody's a little uncertain about how that's going to play out in pricing and cap rates. But I do think the institutional groups are still going to continue to pursue the properties that are leased to credit tenants on long-term leases, as well as the larger, newer distribution and warehouse facilities that are they're modern. So probably the change this year will be folks will start to look more intently at the B infill assets, like we've talked about, as those start to get maintain their occupancy, perhaps get some rent growth.